Good afternoon, I'm Katherine Ross, and I'm here with our London Bureau Chief, Martin Baccardax. Martin, let's talk about the markets. It's another crazy day. I mean, we almost hit down 700
That's
points
right.
for the
Came
Dow.
within a point of down 700. At one stage this morning, we were up 45 or 50 points. So it's been a really incredible day. I think what happened was the oil complex has been leading markets to the downside for most of the day. And then early in the afternoon, we had data from the Energy Information Administration, which said that domestic crude stockpiles rose about 6 million barrels. That was about double the market anticipation. So oil sold off very quickly after that. The energy stocks dragged down both the S&P and the Dow. They fell below 200-day moving averages for the first time in many months. That's a key metric that traders use to judge future market volatility. And at the same time, the key benchmark of volatility, the VIX index, rose to the highest in February. And we remember what happened the last time that happened. So as a result, we get this cascading effect for the second day in a row, down 450 points, 1,300 points plus over the past 2 days. And now we're in correction territory for the NASDAQ as well. So it's been a bloody 2 days, no question.
Oh, for sure. And it's funny because I was talking to Jim Cramer earlier on the floor of the NYSE, and he was telling me to wait and see. By 2:45, we'd see what happened with the market. And about 2:40 was when the Dow really took a tumble.
That's right. He thought the rally started too early, and I think he's correct. Essentially, companies start buying back shares at around 3:30, so very close to the end of the trading day. But at that point, the VIX was just spiking to that February high. So effectively, it was just too early to get in, and the rally got beaten down, and then the losses accelerated. What we're going to have to wait for tomorrow now is what happens with the bank earnings. Actually, prior to that, we're going to have to see again. Remember, we talked about this yesterday. What happens in China? What happens in Europe? Because that will dictate the open. There's been some developments on the currency front in the sense that it doesn't appear that the U.S. Treasury is going to label China a currency manipulator. That's probably some good news, and that may stabilize currency markets overnight, and as a result, could stabilize China stocks. But nonetheless, the way that China and Europe react to this sell-off will be significant, firstly. And secondly, what the bank earnings deliver us on Friday morning. There's going to be 4 major bank earnings, JP Morgan and Citi amongst the most important. If they are stronger than expected with some solid Q4 forecasts, the market could rally very sharply into the final hours of Friday. If they both miss, all bets are off.
What do you think about the bank earnings tomorrow?
Ultimately, it's whether you believe in the yield curve. And by that, I mean, do you believe that long-term rates are going to rise more quickly than short-term rates? The easiest way to think about it is that short-term rates are very sensitive to interest rate discussion. Long-term rates are more about bets on growth. So when you have a curve that is flat, you have investors who think there's going to be a short-term spike in Fed interest rates, but they're not so concerned about faster growth in the long term. When the curve steepens, you get people who think that long-term growth is going to be good, and therefore they don't want to hold bonds, but they don't think that the Fed is going to raise rates very quickly. That's generally good for the banks because they borrow short-term and they lend long-term, and that creates a dynamics for good profit. So if you are someone who believes that the yield curve is going to steepen, you will probably bet on bank earnings. If you're someone who thinks it's going to go flat or invert, which is a great signal of recession, then you probably are going to be very bearish on bank earnings. So tomorrow's earnings will tell us a lot about both. They'll tell us a lot about how the banks see the future interest rate movements and whether or not our expectation for the curve is correct.
And, you know, after such volatile trading sessions, what should investors be looking for?
I think, again, it's looking to stay on the sidelines unless you have to be in. The volatility is just too extreme, I think, for most investors to try to fight against. I mean, this afternoon, Jim's point was absolutely correct. If professional traders started a rally too early and then got creamed to the tune of about 350 points, most of us should not be in the market in those conditions. So it makes sense to stay on the sidelines. Don't necessarily worry, again, if you're looking at a third day to the downside, because as we've spoken about before, if you still believe in what these companies are doing, if you still believe in the strength of the American economy, the foundations for future growth are still there, and you're just going to get a chance to buy in at a cheaper level. If you're not going to buy in, at the very least, wait it out, because the third quarter earnings season is likely to be very strong, and that is going to create an updraft for the market to recover.
So it might be time to take an early weekend?
Let's hope.
Thank you so much for joining me.
Katherine.
All right, we've got some more stories to write. Thanks for joining The Street as we talked about the close, and we'll see you guys tomorrow.